Welcome to Yahoo Finance's Morning Brief. I'm Julie Hyman on this Tuesday, February 17th. We, of course, are coming off of a holiday weekend and also some turmoil in the markets, especially in tech, even as stocks move towards record highs. So let's take a look at what's going on in the futures this morning on the back of all of that, in the wake of all of that, with that as the backdrop. And we still have some stocks under pressure this morning. The Dow futures indicating a drop of about 72 points at the open. S&P futures indicating a decline of 1/3%. NASDAQ futures under the most pressure. NASDAQ 100 futures pointing to a drop of about 0.7% at the open. And while hundreds of billions of dollars have been wiped from software stocks, the selling has not, of course, been limited to that sector. Last week, U.S. stocks recorded their worst week since November. Even the major hyperscalers have lost $1 trillion in combined market cap since their earnings results. Joining us to talk more about this and a lot more is Mark Lehmann, Citizens JMP Securities CEO. And I'm really glad to talk to you about all of this morning, Mark, because you've been in this business for a long time, investing in tech stocks, looking at tech stocks now as a banker to some of these companies. And I'm really curious to get your take on what my producer wants me to call the I can't even say the name right. SaaS-pocalypse? Is that what we're calling it?
It's the first I've heard of it, but I kind of like it. I mean, like you said, yes, I do have a few years on Wall Street, so I've seen a few cycles. They're all dramatic. They all are, to use my daughter's word, scary. But they usually lead to bigger, better companies, and I think that's the same case here.
Okay, walk me through how that happens.
Well, look, we've had transitions over time. As I go back to the 90s, you have this transition to database companies. We had companies some viewers at the show have never heard of, like Sybase, Oracle, and Informix. We all know what happened to Oracle. A lot fewer of us know what happened to Informix and Sybase. We had to move from on-prem to cloud, obviously, that happened 20 plus years ago. We had many transitions over time. A lot of companies did extraordinarily well, and a lot of companies failed. And I don't think this is going to be much different. There's going to be a lot of successes here. There's going to be some people who make some extraordinary bets, but there's going to be some companies who cannot make the transition to what's going on in AI. And that's why the market is so dislocated, particularly in the last month.
Mark, what about this argument that that AI is different, right? Which I know, as somebody who's been around, is something you've heard before about different waves of technology, but that it is different in the magnitude of the dislocation, right? In that it is a replacement instead of really a dislocation on a broader scale. Do you buy that?
Well, in a lot of ways, I do. It's all the changes that we've had in technology is the great disruptor. Let's call it over the last 35 years. That's true. And the disruption is even greater each time because the magnitude as well as the dislocation, like we just said. Is it the replacement? I don't think so. I think for some companies and for some industries it is. I mentioned a few of them a moment ago that didn't make those transition. I think that's the same thing here. There will be some companies who embed this better than others. There'll be some companies who flourish because of this. And then there's going to be some companies who are just not either needed or don't make that transition. So I agree with you. It is the great disruptor. It is the great transition. Is it a great replacement? I don't think so.
There was a fun Deutsche Bank note where they consulted their own internal AI, which I guess uses Gemini as its underlying large language model, and asked it, how is this going to affect things? And I mean, because AI is still largely a summary organism or analyzer, it came out and summarized a bunch of stuff. One of the things that it looked at was that finance was one of the areas that was ripe for disruption. And if I can call up our Yahoo Finance Interactive, I've just been looking at this chart a lot lately of the groups within the S&P 500 year to date. These are the sectors year to date. And I have to say, Mark, there has been a disconnect between investors coming on the show, particularly when we were hearing about bank earnings and saying bank earnings this year are going to be good. These stocks should do well. And then I look at this chart and I see the finance, I mean, granted, we're a month and a half into the year, but the S&P financials are down 5.7%. And there is this view that was once again echoed last week when we had a company called Altruist come out with a new AI model. Asset managers fell. The banks have been under pressure. As somebody who's in this business, how do you think this is going to play out?
In finance, like all industries, it'll be largely more productive. There'll be parts of the company, obviously big commercial banks have both consumer bank arms and have wealth management arms, and they have commercial bank arms, which is what I work for here at Citizens. We're already seeing the productive effects of AI internally. We have this motto, reimagine, which is showing real dramatic efficiencies going on internally at the bank. So as it relates to what we're seeing here at Citizens, I think Deutsche Bank is correct. There will be great disruption, but the disruption is about enhancing what you have as a banker, as you have a colleague who has the tools that they have at their fingertips. We're already seeing it every single day here. As it relates to the asset managers, I think that's a real question mark about what the democratization, which is what technology really does. It democratizes what people have. And I'm sure as this Deutsche Bank researcher put in their own internal Gemini forecast, and I'm sure Gemini spit out, this must be very stressful for you, like all the AI models immediately. I'm sorry you feel that way. But the truth is, it is going to make people better. It is going to make people more efficient. And those who have to embrace it, like we are hopefully at Citizens, are going to be better off for it. But for those who are more worried about it and kind of hiding from it, I think that's the problem. And I'm not saying a lot of companies are, I don't think they are, but for those who are not really embracing this full throttle, that's what's going to happen. And you start out with the software industry, but it's really across everything, whether it's healthcare, technology, consumer, financial, whatever the industry you're in, you're seeing the productive benefits of that. I don't think we're going to run out of workers here. I'd say it all the time. 35 years ago, when we created spreadsheets, we were worried about what's going to happen to the accountants of this world. We have more accountants than we did 35 years ago, and I think that's what's going to happen today. It's a different job, and that's what we're seeing.
I mean, all of that said, I was really struck by two pieces last week. One was in The Atlantic and sort of looked at the real differentiator in how this technological wave is going to hit is going to be speed, right? Are companies going to have time to adapt, or is the wave going to come so quickly that neither they nor policymakers will be able to meet the moment? And the other one that I'm sure you saw, because it was making the rounds, was a Substack by a guy named Matt Schumer, who's a software developer executive, who said, like, this thing's a freight train, it's coming for you, and you are not ready. Now, of course, everybody piled on and tried to debunk part of what he said. But, how are you, it sounds like you have a much more optimistic view than the freight train view, certainly. I guess that there are just a lot of people out there who are afraid right now, even if they're embracing, in some cases, because they're embracing the technology, is why they're afraid, Mark.
I think both can be true, right? You see this freight, it is a freight train, right? You're hearing all these stories about people who work at these big companies and what they're creating, and they're going home and talking to their friends or spouses and saying, oh my gosh, you have no idea what's coming. I think we're soon going to say, we're not saying, oh my God, anymore, because we've heard it so many times. The reason I embrace it is just because it's happening. We saw this earlier in the 2000s with the internet and what it did to some consumer companies and what it did to start with bookstores, obviously, which is what the first thing people felt it on. I think you just have to understand that it's coming, and you embracing it and learning about it, and you incorporating it in your life, and you incorporating it in your work, and you incorporating it in what you do is absolutely going to happen. Every technology revolution is faster than the last one. And we've seen these adoption curves. It starts with microwave ovens or VCRs. I can't remember which one it started with. And you see the adoption curve with ChatGPT, which or OpenAI, whichever one you want to pick. They're faster than the last time. And I think companies that embrace this technology and embrace the speed of this, embrace the possibility of it, are going to do far better. And I think I juxtapose this with 10 years ago when we said we're going to run out of workers because everybody's aging out. Well, now we're going to need fewer workers. So I don't know what that argument says anymore. Governments, we haven't even talked about what the government has to do to embrace the fact that we're going to have this kind of workforce that's going to be much more empowered, but it's probably going to need fewer people. We haven't even talked about healthcare and the benefits of that, and the benefits of all the things that you're going to learn about yourself. And doctors are going to learn speed to market of drugs. The FDA is going to have to go faster. Julie, those are all positive things for the economy and for our lives, but they're frightening for people who just like it the way it is. Because I'm sorry, nostalgia is a wonderful thing, but you look back, it wasn't so great sometimes. Look back, I'm not sure people would trade having no internet for 30 years ago. They'd much rather have this.
I'd trade away social media in a second, Mark. A second, a millisecond. Life was definitely better before that. But that's a whole other, but that is a case study for something where it developed without a lot of guardrails, without a lot
Julie,
of policy.
That's a great example, okay? I have been on the show with you, and we talked about Congress figuring out how to regulate Meta, et cetera. We'll call Meta and their progeny, right? Or Facebook and their progeny. I've yet to see it. Right. Mark Zuckerberg raised his hand 5 or 6 years ago, begging them to regulate them because it was going to be good for their company. Never happened.
Well, isn't that a problem then? If Congress is not going to do it, and you have this technology that we're saying now in the form of AI that is so unbelievably powerful, we're already seeing some of the pitfalls of it. You have some lawsuits, for example, from people's loved ones who have committed suicide, for example, and they say that the AI, the chatbot sort of walked them down that path or didn't discourage them. So if that's already happening and we're kind of at the beginning of this, do you have any confidence that Congress is going to step in and protect us from it?
It's a hard question. I think Congress is going to have a hard time because they're late, right? They're generally people who are my age. They're not 30-year-olds who know how to use this tool and how to really use it productively. They're good at regulation and oversight and other things. They're not good at looking out and seeing the future. So my hunch is no. And that means self-regulation and people who police each other and the investors, and you hope for moral compass. I think hoping Congress becomes the lead dog in this fight is a bad idea. Yeah. But I also think there are these warning signs, and there are these articles, you mentioned a couple just now, where people are saying we got to wake up to this fact. Hoping for that hope's never been a great strategy, but I'm an optimist. People who work on Wall Street, generally being a pessimist is a bad idea because things generally work out and markets do go higher. We're embracing these technologies here. I think you have to understand that there's a force for good here. But if you're not there to understand the downside, you're going to be, I think, sorely mistaken, and you're also going to be late.
So, Mark, okay, let's take the investing side of this, because, of course, that's the other thing that people have to be aware of here. Where are their opportunities from that perspective? Not just like, how am I going to save my job, but how maybe can I invest intelligently in this whole theme? And once again, I'm going to pull up the Wi-Fi Interactive, and I've got a board of software stocks. And I don't have to tell you what this looks like. It looks ugly, right? Microsoft down 17% just this year. Oracle down. Palantir down 26%, although obviously from big highs in many of these cases. Shopify down 30%. So if I'm an investor, and you have the benefit of conversations that you're having with businesses that are in technology, how do I know where to pick up things on this board or on any kind of tech board right now?
It's hard. I think some of those, like you said, were company specific. Palantir had an extraordinary 24 and 25, and obviously the bigger they are, the harder they fall. I think you could say somewhat the same thing about Oracle. Oracle got so much buzz at the end of last year when they started to get into the markets that they frankly hadn't played in before with data centers and others, and they went up extraordinarily high, probably got ahead of themselves. So the issue is, are there people who with AI are going to be beneficiaries of that? We have Pat Walravens, our research analyst, spends a lot of time on that with his team, trying to figure that out. We've been very specific about this. Let's step back. Software stocks over the course of the last 30 years, at their absolute summit, had traded at 20 times revenue. At their absolute trough, they've traded 2.5 times revenue. They're trading 3+ times revenue right now. They've gone down an extraordinary amount. Does that mean they're all buys? It obviously does not. But we're picking some names. We like Oracle. We like DigitalOcean. We have a conference in 2 weeks in technology in San Francisco where many of these companies are going to be speaking, and they're going to be speaking specifically about this issue. It's a great time for people to really attend these meetings. You're going to be able to listen to the company's commentary. There'll be lots of transcriptions available on public websites. Use those to your benefit. But a lot of these companies, I'm going to say it again, will not thrive or survive. And we saw the same thing happen in these last couple cycles, and that'll be the same case. But this is what happened 20 years later, Microsoft traded flat for about 15 years, from 97 to 2012 or 13. Microsoft did not go up at all. And in the last decade, because of what happened in the cloud, the stock has done what it has done. Microsoft reinvented itself. Apple reinvented itself. To some extent, those are the only two companies that I've seen truly reinvent themselves.
So
you're going to see some companies have to reinvent themselves now. Oracle has sort of reinvented themselves in a big way and then came back. That's what's going to happen, Julie, in the next few years.
So going back to what you were talking about before about companies having to embrace this, I think something that some investors struggle with is how do we measure it? You know, there's been a lot of talk lately about return on investment, right? We saw the Bank of America Fund Manager Survey today showing that investors, while they're optimistic, they're uncomfortable with the amount of CapEx that's coming out. So again, if I'm an investor, whether I'm listening to a hyperscaler or a software company, what do I need to pay the most attention to know if this company is really integrating AI and that it is boosting the bottom line? I mean, do you just go do the classics and go back to looking at profitability and, you know, the sort of bread and butter stuff? Does that really tell us what's going on here?
I think you do have to look at kind of the investment spend and the kind of return on that investment spend. I think you also have to see what's going on with their historic business and how quickly that is degrading given what's going on in cloud. You see Salesforce, which is one of your plus 20% fall from peak to current. They have 600 million in AI revenue right now, tripling year over year. Is that enough for them, for their historic business that they have? I mean, Salesforce had a motto for a while that had a software sign and a Ghostbusters right through it, no software. It's really interesting to show that. Now it's going to be, do you want to sell services or not, which is what they've been selling for a long time. So the question is how quickly that investment spend is paying them back. And like I said, a couple of those companies, many of these companies, I think are throwing some things in the hope phase. I think there's some that we just mentioned that are not, that we really feel are winners. There's a company that went public, we helped take public, that has done poorly in the public markets called Lehmann, that is down significantly from their IPO from the fourth quarter, but they're a beneficiary of AI because they embedded in all the travel and other leisure products that they have for companies. You're going to have to find companies that are really benefiting from that. And there are going to be some extraordinary winners, Julie, who do that. And I think it is incumbent upon investors to really pay attention to that and not understand that this is a monolith and it's just the software whole sector is going to go away. But we look at the top 20 software companies from the early part of this century. It was SAP and BEA, and I mean companies I couldn't, you wouldn't, Lawson Software. Many were bought, many went away, some have survived. But I think you're looking at 50, 60% of the top 30 software companies now that will either get bought or go away is not a terrible number right now.
Funny coincidence, Mark. We just switched here to Navan as our internal expense software, so that's kind of a funny coincidence. I do want to get some thoughts from you on the IPO market because once again this year we came in, everybody is so excited. We're looking for OpenAI, we're looking for SpaceX, and you know, we had some IPOs out of the gate, but in the past couple of weeks we've also had a handful of IPOs cancel or postpone their offerings, right? There's a list of some of them there. So, you know, what does that cadence look like, especially with these worries around software in the market?
Yeah, it's a good question, Julie. I think there are going to be more IPOs in 2026 than 2025. I think the width of the market is definitely going to expand. We've seen that here at Citizens, and we're seeing that in our backlog. I think it's not just going to be a tech market. I think it's going to have a variety of opportunities. We had one that we took public earlier this year called Equipment Share that's out of the quiet period today that's done extraordinarily well. I think what that's telling you is valuations matter. I think it's also telling you that this is not just go public, it's all going to work out. You really got to price these things correctly. You really got to understand who the buyers are. I think historic numbers, some of the people who raised capital in 2021, that's an irrelevant data point. I think you got to really understand what the marketplace is looking for. But I do think it's going to be a more productive 26. I do think the width of the market is going to go up. And I do think the buyers are there. You talk about it. People are looking at the market like it's been so awful because the NASDAQ's had a couple bad weeks, but the overall market is healthy. The rates are coming down for the market. The White House is really focused on interest rates, affordability. We got an election year coming. That's 9 months away. I think it's really important for Wall Street to make sure they price these offerings properly. Some of those cautionary tales that once got canceled, frankly, are a good sign because it shows you that pricing matters.
Mark, this has been awesome. Thank you so much for spending so much time with us. Appreciate it.
Thanks, Julie.
Talk to you soon. Coming up on Morning Brief, we're bringing you today's top trending tickers and count you down to the opening bell. Now time for some of today's trending tickers. We are watching Warner Brothers Discovery, TripAdvisor, and Massimo. First up, we've got another chapter, yet another, in the sale of Warner Brothers Discovery. The board is reopening talks with Paramount. The last 7 days after Netflix granted WBD the right to engage in more discussions with Paramount to hear out their, quote, best and final offer. Warner Brothers board says it continues to back the deal with Netflix despite a renewed sweetened offer, remember, from Paramount last week. All of this may reignite a bidding war as WBD's board aims to squeeze as much money out of its suitors as it can. Next up, we're looking at TripAdvisor. Shares under pressure as the Wall Street Journal is reporting that activist investor Starboard is pushing for a majority slate of TripAdvisor's board. Starboard has reportedly built a stake in the travel company worth about $160 million. The investor has publicly expressed opposition to TripAdvisor's strategy in recent months, especially over the company's plans to sell its restaurant reservations tool called The Fork. Shares in TripAdvisor have already been under heavy scrutiny amid the recent software sell-off. They're moving up by about 5% this morning. And finally, medical device maker Massimo. Shares are surging. The FT is reporting that life sciences manufacturer Danaher is buying the company for nearly $10 billion. Massimo is a leading maker of pulse oximeters. That's a device that measures blood oxygen levels. The company's stock is down almost 50% over the last 5 years. It's faced a set of challenges from activist investor pressure and a patent lawsuit. Remember this with Apple over its wearable tech. The shares up 34% this morning. Coming up next on Yahoo Finance is Opening Bid with our executive editor, Brian Sazi. He's here now. What's coming up today?
Julie, wasn't Massimo a clothing brand?
It was that with 2 S's. This is the 1 S Massimo.
I mean, I gotta ask you.
I think they still sell that other one at Target.
Yeah, they probably sell TJ Maxx or Marshalls, Julie. But yeah, I'm not going to talk about any of that on the show on Opening Bid today because I don't even know what the hell the company does. I am going to talk about this Norwegian cruise line situation. I'm fascinated by the new CEO in there. That CEO used to lead Subway, which I just think is a ludicrous decision. We're talking some AI, talk some stocks. That's how we roll.
Maybe they're going to have some Subway on the cruise ship?
I'm not booking Norwegian if they put a Subway on a ship. Just not doing it.
Can you imagine a whole cruise ship that smells like that?
No, I can't. But I do get the tie-in. Subway sandwich, submarine. You should be the CEO of a cruise line. It all makes sense to me, Julie.
Okay, I got it. All right, looking forward to that, Saz. That does it for Morning Brief. Opening Bid is next.